The coronavirus stock market impact is immense. It is spooking stock markets. The Dow Jones Industrial Average (DJIA) shed 12% or over 3,000 points over 5 days, February 24 to 28, the largest 5-day drop since the Great Recession. The DJIA recorded the biggest single-day drop, 1191, during that week on February 27. China is a key player in companies' supply chain. That's why analysts fear firms in China won't deliver parts to companies like Apple and Walmart, which will cause these firms' results to suffer. The fear of the unknown is causing panic. Stock markets hate uncertainty, and this virus comes with an abundance of uncertainty. When will there be a vaccine? How will countries contain it, and so on? Coronavirus stock market impact could linger. Nobody knows how long the coronavirus stock market impact will last. But history shows us that stock markets overreact and then continue their upward momentum. Today, the rapid proliferation of the virus increases fear, so people are overreacting. We need to pause and not rush to the exit. Markets recovered quickly from past viral outbreaks. Will the coronavirus stock market impact lead to a realized capital loss to you? The market change, per se, does nothing. You lose funds only when you sell below market price. Some firms' results will suffer in the short to medium term because of insufficient inventory. Other companies will gain. Although we do not know the virus severity, judging from past market responses, caution is the key response. Are you a value investor with targeted companies in your portfolio? Examine your goals and stay the course unless you see changes in the firm's intrinsic value. Have you been speculating, looking to make a quick buck with a margin account? If so, you will have a challenge because banks will call your margin. That's the inherent risk when you use a margin account to speculate. If you are not a speculator but a value investor, now could be the perfect time to identify value stocks and select those at bargain prices. There will be several. Whoever you are, be cautious, reject the herd mentality, and reflect on these matters. Stay the course. Review or develop an investment goal and plan before you adjust your portfolio. Why have you been or do you wish to invest? Your reason will decide your investment strategy. My preferred strategy is to buy blue-chip equities with a long history of increasing dividends. I hold these shares, review their fundamentals from time to time, and act when there is a permanent change. You will find value stocks today. Market fluctuations provide a great opportunity to buy solid companies with good track records. Remember, you lose or gain on sale only, not when markets fluctuate. When your investment's intrinsic value change, confirm your strategy, and sell your holdings, even at a loss. Don't time the market recovery. The market could be down for several years like the Tokyo stock market, which has been below its bubble heights for over 2 decades. Don't let generic asset mixes influence your asset allotment between stocks, bonds, cash, commodities. You are unique, and your mix should fit you at your life stage. Think before rushing to so-called safe haven commodity assets such as gold that has no intrinsic value. If you are in the retirement red zone, 5 to 7 years to retirement, your goal must be capital preservation, so avoid the stock market. Don't panic, focus on your goals, plan, long-term strategy. Update these and ensure they fit your needs and your risk profile. This, too, will pass, but God alone knows the timing. The global stock market slid for the 6th straight day on Thursday, as the S&P 500 index plunged to its worst loss in almost 9 years, and investors worldwide grew increasingly fearful that the coronavirus outbreak could cause a recession as it squeezes corporate profits. The S&P 500, which just last Wednesday reached a record high, slid 4.4%, its worst day since August 2011. The index is down 12% since that peak, entering what is known as a correction, a drop of at least 10% that signals a more significant sell-off than a few days of pessimistic trading. The downturn continued on Friday, as Asian markets closed sharply lower and European stocks tumbled at the start of trading. The widening scope of the health crisis threatens to overwhelm global supply chains, especially in China, the world's second-largest economy after the United States. In addition, the outbreak could crush consumer demand, as people limit travel or stay home even without a government order to do so. Scott Clemens, the chief investment strategist for private banking at Brown Brothers Harriman, said the outbreak's potential to alter American consumers' habits was at the heart of the sell-off. To the degree that consumers change their behavior, so they stop going out to eat, they don't take the vacation, they cancel the business trip, that consumption, that spending, personal consumption is 68% of GDP, Mr. Clemens said. Over the past few days, companies as varied as United Airlines, MasterCard and Pfizer have said the outbreak poses a threat to their 2020 earnings. Get an informed guide to the global outbreak with our daily coronavirus newsletter. And analysts at Goldman Sachs predicted on Thursday that companies in the S&P 500 would generate no profit growth this year as a result of the crisis, because of a severe decline in Chinese economic activity, disruption in the supply chain for American companies and a slowdown in the U.S. economy. On Wednesday, President Trump addressed the outbreak, expressing confidence that the risk to the United States was low. But investors were clearly not convinced. When you get into a situation like this, it cascades, and that really becomes a problem, said Steve Sosnick, chief strategist at Interactive Brokers in Greenwich, Con. As stocks were falling Thursday, other countries struggled to contain the outbreak. Prime Minister Shinzo Abe of Japan asked all of the country's schools to close for a month. Health officials in Germany reacted aggressively after a man with no known connection to anyone infected with the coronavirus had tested positive, closing schools and urging some who may have come in contact with him to stay home for 2 weeks. In Italy, the number of coronavirus cases rose to 650, and in France they more than doubled to 38. We have before us a crisis, an epidemic that is coming, said President Emmanuel Macron of France. In Europe, Denmark, Estonia, Norway and Romania all reported infections for the first time, joining Austria, Croatia, Germany, Greece, North Macedonia, Spain, Sweden and Britain. And concerns grew about the severity of the outbreak in Iran, the source of infections in many other countries. The government there said Thursday that 245 people had been infected, including a member of President Hassan Rouhani's cabinet and 6 other officials, and 26 had died. The outbreak hit foreign markets hard, too, where the slump continued into Friday. Indexes in Shanghai and Japan closed 3.7% lower, and European markets opened sharply, with the DAX in Germany down 3.4%. Futures pointed to a slide when Wall Street starts trading. The S&P 500 is on track for the market's worst week since the 2008 financial crisis, and other economic indicators are flashing warning signs. Oil prices have tumbled as people cut back on travel and investors worry about a slump in industrial and consumer demand. Meanwhile, money has poured into investments like gold and government bonds, which are generally considered safer. Bond markets, which are far larger than stock markets and especially sensitive to the outlook for growth and inflation, were broadcasting pessimism about the economy even before the outbreak. That pessimism only increased this week, as prices for corporate debt from even the safest of borrowers fell and investors rushed to government debt. Demand for U.S. Treasuries pushed up prices and drove down yields. The yield on the 10-year Treasury note, a closely watched barometer of investor outlook, fell to a record low of 1.29%. But the performance of stocks was especially stunning. Randy Watts, chief investment strategist at William O'Neill, an equity research and advisory firm, said the sell-off could get worse, because investors may be wary of holding on to stocks over a weekend. That could bring more scary news. I think this is bad, especially going into a Friday, he said. Shares of Microsoft, the most valuable company in the United States, fell 7% after the software giant said on Wednesday evening that its sales in the current quarter would be lower because of the outbreak's effect on its supply chain. Anheuser-Busch InBev, the maker of Budweiser, forecast a steep drop in quarterly profits. Its shares fell 9%. In the United States, consumers have been a bright spot over the past year, even as the trade war prompted a broad-based slump in business investment and manufacturing. Part of the reason is that the Federal Reserve has kept interest rates low, which prods consumers to spend more. But that won't necessarily work if factories are closed and consumers aren't willing to risk stepping outside. Lower interest rates are not a cure for the coronavirus, said Mr. Clemens, the private banking strategist. Already, the consensus estimate for first-quarter domestic growth has slipped to 1.5%, according to data from FactSet on Thursday, from 1.7% at the end of 2019. That moves it beyond the sphere of people feel bad because their 401ks are down, Mr. Clemens said, and into the sphere of economic reality.